The market is still more susceptible to shocks compared to the pre-pandemic era. And there's one specific way you should be positioned. Joining us now, Cameron Dawson, Field Point Private Chief Market Strategist. Cameron, thanks for joining us. Great to see you. My first question, kind of similar to what I just posed to Jim, but for the broader markets. Do you think valuation multiples might come down next year?
I think that is certainly a risk for this market. So the earnings backdrop is still very solid with good economic growth. But given the fact that we have seen this very ultra-loose, ultra-accommodative interest rate policy environment be very supportive for multiples, the risk to multiples is that rates go up and it's really real rates going higher. And that's the biggest risk for growth stocks here, because as real rates have fallen from positive 1% in 2018 all the way down to negative 1% today, we've seen growth valuations go from 17 times to 34 times today, as Jim said. So the challenge that we have if you're way overweight growth is that if you start seeing those real rates move higher, the risk is that you could see a lot of multiple compression. So despite what's going on in the earnings environment, despite the fact that these are names with strong secular growth tailwinds, we could see a more choppy trading and even underperformance for growth names because of that multiple compression.
So it sounds like you're making the case for value stocks, Cameron. What do you like in that environment?
So we do think that we need to move to becoming more balanced between value versus growth. We don't think that we're ready to move to a call of saying go overweight value. To go overweight value, we'd really need to see things like a much weaker dollar and sustainably weaker dollar. We'd also need to see a much steeper yield curve and again, those higher real rates. But what we like within value is that we kind of want to de-emphasize the financial parts of the value sector. We see some pretty weak areas of things like banks, insurance. All of the relative performance trends are rather weak in financials. Where we do see things that we like within value is more in the real estate. We see good things happening within materials and healthcare as well. So moving to be more underweight the financials within our value exposure and overweight these real estate, materials, and healthcare, which are really more late cycle as we move again later into this cycle.